Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields still hovering inside of that range. Recall that range used to be 230 to 240. We saw a significant shift. We saw a curve start to modestly steepen, and then we widened that 10-year range out to 230 to 250. And now we're kind of stuck in between there. We've been hovering close to 240, today closer to 245, but ultimately we're still in a range. We haven't really seen a significant move in one direction and continue that move. We've seen, obviously, the move above 240 was significant, but the inability to hold it technically has really kept the market at bay. And if you look at implied volatility, market volatility is non-existent. And I say non-existent because it hasn't been around in quite some time until it is. Volatility has a strange way of revealing itself, whether it be through fear or whether it be through some kind of an announcement, unexpected announcement. And right now the market is anticipating slow and steady Fed rate hikes. They're expecting stronger U.S. Economic data. They're expecting some kind of positive turn, whether it be from tax returns or whether it be from the economy. And so anything outside of that could bring back volatility. But ultimately right now we aren't really seeing that, especially in the tea leaves. Right now, any moves higher in yield are going to be hit with some pretty good resistance due to the uncertainty, not only of inflation, but really the economic data. While it has been strong and it has been building, we want to see it for a sustained period. And likewise, with the Fed wanting to certainly want to keep rates under control. They don't want to see an explosion in rates. They want to keep lending rates under control. Yes, they do want to get us off the zero bound, which they've done quite nicely over the last year and a half. And lastly, if you look at what is ahead, we've got the employment report coming out Friday. ADP today was very strong. So the private sector showing very strong job growth. That should be revealed tomorrow as well when we see the non-farm payroll number from the BLS. I think that will probably continue to see yields creep higher, but I don't think that's going to be a reason why we see things change and why we break out of the range. Likewise, if we do see a trade to 250, it's probably going to be a buying opportunity for many, given that there isn't a whole other amount of opportunity out there at that yield level. So right now, the bond market's still hovering within a range, volatility low, and don't expect much from tomorrow's payroll number unless it's way weak. And if that's the case, yields are going the other way and will still remain inside the range. This is Todd Colvin coming to you from the floor of the CME Group.